Hi, everybody, and thank you so much for joining me. My name is Lex from Consensus, where I'm the head economist and the global fintech co-head. In this session, we're going to talk about the transition of finance from traditional systems, from the systems that exist today, to financial technology as it was formulated in the 2000s and the 2010s, and now to digital assets and decentralized finance, which are going to cohere together into a new digital economy and financial system. And so with that, we're going to try and go fairly quickly and fairly deep into substance to prove some of these points. And with that, I'm going to share the screen. There we go, slideshow from the beginning. Fantastic. So as I mentioned, we'll try to paint this story progressively and really anchor into the developments that have happened and the innovation that has happened that is separate from the theater and the stories that have come about these transitions. Just a bit about Consensus. Consensus is a leading blockchain software company. So you know particularly the way in which I'm biased, but we run the largest Web3 crypto wallet called MetaMask to access the open finance ecosystem. We also have one of the largest developer footprints for software that's being built on blockchain, including decentralized finance software, as well as working with the banks, governments, and other financial institutions to deploy blockchain-based engagements in the work that they do. So check out Consensus, and of course, take everything I say with a grain of salt, given this is my incentive. Okay, so fintech progress to date. We start at the level of the economy, at the macro economy. And we know that financial services is somewhere between 15 to 20% of gross domestic product in developed economies. That has shifted over time, right? So finance as a sector has grown, replacing manufacturing and putting in place services and sort of the financial transformation functions as things that contribute to the economy. And that has increased over time. And we know that fintech has come about really in the last decade or decade and a half as a venture capital theme. So we've had this expansion of financial services into GDP, and then really a dearth of early stage technology investment into it. Other things like media and healthcare and so on were being digitized with the rise of the internet and automation. But financial services had regulation, and it seemed very difficult to get into and all these things. And so you can see back in 2007, only 5% of venture capital was in financial services. And two things happened. First, the overall share of VC in finance went from 5% to 17%, which is the equilibrium in GDP. And then number two is the overall amount of early stage venture investing to grow technology has massively ballooned as well. And so we have these two secular tailwinds generating lots and lots of companies trying to pull financial services apart. Now, this is an old story. This is a 7-year-old picture saying, let's take a bank, pull it apart into their features and functionalities, build vertical brands and applications about it, and try to blitz scale those into large footprints. And most of the logos on the prior page are dead and irrelevant, but some of the logos have turned into vertical champions, vertical meaning they dominate a user footprint for what they do, where, for example, SoFi dominates student lending, Revolut may dominate FX-based neobanking, uh, Robinhood for trading, Betterment for wealth management, and so on. And they've built large enough footprints that now the game is about monetization and adding on adjacent features, creating a fintech bundle. And of course, the banks have had time to catch up. It's no longer a fintech only game. Most of the banks have undergone some sort of digital transformation program where they've turned their users into digital app users, where they've essentially copy pasted the ideas that robo-advisors, digital lenders, and other companies in fintech have put together. So, the largest robo-advisor is either Vanguard or Schwab. One of the largest digital lenders is Goldman Sachs, and so on and so forth. And then the last piece is the role of the tech companies. And in 2021, you can't seriously say that tech is not in finance. It's sort of a losing proposition. Not only are they in finance, but I personally believe that they've won the distribution game between Apple Pay and Google Pay and Square and Amazon, as well as Facebook with payment processing all over the world. While there is a regulatory barrier, it is largely irrelevant to the customer acquisition that the tech companies have done. And so this is the kind of the third leg of the competition that we see. So economics 101, when you create a ton of supply, what you get is a collapse in price. And so if you look at digital wealth, price has gone from 150 basis points down to 25 basis points. If you look at international money transfer, it's gone from 60 basis points or $60 on $1,000 transfer down to 4. So really large changes in pricing across the various functions where banks used to be able to have much larger margins. And in part, this is happening across all the different, right now we're talking about consumers, so let's stick there. It's happened across all of the different consumer functionalities, right? So you start with messaging, and then you get to money in motion and payments, and then you get to money at rest with savings. Then you might have lending, borrowing there. And then you start to take your savings and do trading and longer term investing, planning for retirement, and finally, single life events like insurance. While regulated, this stuff used to be a part. From a consumer experience, from a technology experience, there's really no difference between any of these things. They're just buttons you press on an Apple phone. And so you have a blurring of all this stuff together. And of course, in the East, with the super apps, whether it's WeChat or Paytm or Ant Financial, there is no difference not only between the financial features, but there's no difference between the commerce that they enable as well. So if you're paying for a taxi, or if you're buying toilet paper or groceries, or if you're investing into a money market fund, these are all trivially integrated into the same super app. And so the Eastern model has gone ahead, and it's only now that the West is starting to catch up with embedded finance, with Shopify, with Stripe, and the ideas around putting finance as features into APIs and into the social media apps. So that's the story of fintech. And there's a thing that's really missing at the heart of the story. There's a lot of stuff about distribution. How do you sell financial products to people? And the story is largely, instead of selling it person to person or in a bank branch or with a financial advisor, you sell it through a phone. And so if you want to say kind of a toy version of fintech, it's putting finance into the phone. And there's a bunch of stuff around the middle office. So making CRM more efficient, making account opening faster, making better portfolio management software and rebalancing software, making better underwriting software. While important, that process automation is about sort of speed of turnover rather than about something fundamental. And what is missing in all of this is the fundamental innovation in the manufacturing of financial product. the thing gets made in the same way that it was 50 years ago. It is on the core banking system. It is in the card network. It is the same 40 Act investment fund. It is manufactured in the same way as it was prior to the digital revolution. And so that can't be. If you look at all of the other venture cliches, you look at these moments where industries broke, you have the manufacturing actually become digital. So in the case of Spotify and music, you have the digital music file. In the case of Google, the content goes from a book into a digital a website, right, into zeros and ones that are generated and stored on the internet. In the case of Netflix, the media file, the movie is digitized, and the form of it is transformed. And for finance, that's been an open question. And there's an answer to this question. Not surprisingly, it's the answer that I believe in, which is that blockchain-based finance and blockchain-based financial product manufacturing is the step function for the financial services industry. That is both terrifying and profound. So blockchains have a number of attributes that make them property rights systems, that make them economic systems. When they are computational, that's even more powerful, and we'll talk about that. But just by being property rights systems, it means they have authenticity and scarcity of assets. Nothing like that had existed prior. There's no digital scarcity in the traditional internet model. Similarly, there is massive mutualization of standards and protocols and data. So you remove those barriers of payments to savings to investments and so on, but you remove them not just in distribution, not just in what buttons are in your phone, but in the actual making of the product. And this is quite fundamental. The other thing about blockchains is that they are transparent. And so unlike in our traditional financial system, you can actually see exposure all the time in real time. And that is a good thing for compliance, for risk management, and for the types of things that people tend to have anxiety about when thinking about crypto assets, but those anxieties are coming from a place of misunderstanding rather than kind of seeing the core architecture of what a blockchain does. And so with that, you get to a point of we really are in a shift for what it means to build fintech. And there's a lot of traditional incumbents trying to kind of wrap around this in the way that they were trying to wrap around digital transformation in the past. And so you can see the number of enterprise engagements going up. You can see the number of people dedicated to blockchain practices going up. You can see issuances and launches and capital markets activity from incumbents trying to participate in various consortia. And so every single bank you can think of has been involved in blockchain-based finance or has been building systems to take advantage of these things. And you've got regulators who are moving along as well. So the large kind of regulatory bodies, while again express often individuals in those regulatory bodies often express certain anxieties or framings of the sector. The underlying reality is that this innovation is starting to get the freedom and the space to actually move around real assets. And traditional assets like fiat currency are being packaged into blockchain or digital wrappers as well. So of course, central bank digital currencies are a big theme. Having central bank digital currency that sits inside of the financial apps, the super apps that we talked about before, is already in play in China and is a large driver for the regulation of the fintech companies. We know that Ant and WePay do power and will power more broadly the Chinese CBDC. And by contrast, that means the American and European systems need to respond. But that is really just that is not the leading part of the innovation. The incumbent work on self-digitization is a reflection to the things that are actually happening. So you can think of the traditional world, implementing enterprise blockchains and then implementing partial tokenization, where the sort of the tokens are merely hyperlinks to some real world set of legal documents and so on. And today there's a lot of retrofitted packaging of tokens into alternative investments. So think about Bitcoin ETFs. At the same time, in the open source economy, what we see is decentralized protocols being built, interconnected, and all the financial software that one would manage to generate, underwrite, intermediate, and control financial products, or the machines, the factories that make the financial products, those are being written into the network itself. And so going back to this point about, we need blockchains that are computational, that are programmable, which can execute software. This is really the step function for fintech, because financial technology can then live in an open source mutualized way, which therefore allows financial products to be built according to global standards and in an open way. And you can think of, so what is a decentralized machine that generates financial products? You can think of decentralized exchanges. Some folks call them automated market makers, as one particular innovation. And so this is a way, for example, to trade without an order book and to trade without a counterparty algorithmically against a liquidity pool of assets. So according to some particular mathematics, there is a way to exchange one asset for another along a curve, and then the market makers that enable that earn a fee. And so you're innovating in how much bandwidth and computation an exchange model needs to have in place, and how many participants and the types of participants it needs to have in place. And now these types of market makers are running at over $1 billion in fees per year. Another example would be a lending protocol. You can think of it as a margin lending protocol, where you take one asset and lend it out for an interest rate, or borrow it at some interest rate, and the spread goes to the protocol as well as the provider. And so this is to support various capital markets activity as well, and can be done entirely through software. No negotiation through a counterparty, no syncing of data in anything other than the smart contracts on the blockchain. And so this has led, this being the creation of these fintech machines, has led to really fast growth in the computational blockchains that support that, where Ethereum now has 150 million addresses, which are sort of like the equivalent of accounts in a financial system, and probably close to 2 million decentralized finance users who have engaged in transactions with these assets. The software is executing on the network in an increasing manner. And this is you should not look at crypto prices. You should look at the actual execution of contracts, of the software, and the number of transactions, right? Like, are things being done? Is there operating progress? And there is very strong evidence of people using these financial systems as part of their livelihood. There's now about 100 billion, 75 to 100 billion of collateral that has been deployed. This collateral that supports the lending functionality, the exchange functionality, insurance functionality, and a number of other what's called financial primitives, but essentially financial functions that plug into a user experience. And again, these functions are done by what are called protocols, the equivalent of applications, with the main difference that these protocols are deployed on a network, executed on a network, and synced on a network. They're often governed by the community that uses the protocol, and the value, the actual fees generated by these things flow not to some private company, but back to the community in the form of either a treasury they control or in the form of fees that accrue through participation. And so this is a mentally different model of what it means to deliver finance to people. And it also is a different type of thing that you, in terms of how you write the software. The net outcome of this is going to be that Ethereum has been remapping different financial services sectors and the financial services instruments that they've created. Of course, it's not just Ethereum. There are other computational blockchains. There are various solutions to make things scale faster or easier. There are a number of competing blockchains too. But the end result that you see is that it's essentially all across the different types of things that you would expect a financial industry to do. Most of them are now being rebuilt in one way or another into programmable blockchains. And so with that, just to kind of bring it all together, you know, we've talked about how financial services as an industry holds a large portion of GDP, and then how the digitization of distribution has led to about 10, 15 years of boom acquisition, customer acquisition on the fintech side, but it hasn't led to disruptive underlying change in how finance is built, how financial products are created and made and delivered. And where we are today with blockchain is that while yes, the banks and financial institutions are working on applications to transform their middleware and their infrastructure, it is really the open web that is delivering very novel machines and mechanisms that can recreate the types of outcomes we expect out of finance. And so if you bring all of that together, what you're going to be left with is the idea that the themes of fintech distribution have no choice but to connect to the decentralized finance rails. And so today they scotch tape over the traditional finance rails. They use APIs on top of overnight batch processes and things of that nature. And they distribute zero interest rate bearing accounts. And in the search for profitability, in the search for yield, in the search for new asset classes, the natural move for essentially any fintech with any distribution footprint is to plug into the decentralized rails. And for this, they are very well equipped. And the reason they're well equipped to do that is because they have never really owned the banking rails, and therefore they don't care about the banking rails. They care about customer acquisition, and then the underlying financial products are just an integration underneath. And so over time, I'd expect to see more and more fintech footprints connected to DeFi products. And as more people own them, there's more demand, more development, and it's a virtuous cycle of investment, spending, and growth. And so that's where I see the financial services and innovation industry going. Thanks so much for the time that you've given me to talk about these themes. If you want to check out more, go to consensus.net to learn about what Consensus does, and follow me on Lex Sokolin on Twitter if you're interested. Thank you so much.